Greetings, class, and welcome to April the 24th on Friday. This will be an announcement video and a review of the material that's in the multiple choice final review document right here. So for announcements, remember the Chapter 13 homework will be due on Wednesday the 29th. Um, and that is over the material we covered earlier in the week. Also, chapter 12, 13, and 14 vocab quiz is due on Friday. I mentioned this earlier, I believe, and it's just now showing up. So here it is. We just finished with chapter 14 earlier this week, and a discussion that's actually going to be due on Monday this week instead of Friday. So instead of the normal discussion due date of today, the 24th, it will be Monday the 27th. And I did that because I actually got that up a little bit later than I wanted to, so I wanted to give you some more time. Also, I wanted to mention a couple things about our final exam. There's final exam policies that are distributed every year in every semester, and this is what we would get normally as a schedule for our classes in this semester. So here's what I'm going to do. Each of you are in a different section, and I'd have to explain. Okay, for your section, it's going to be open this period of time. The requirement, the way I understand it, on the online portion is that we have the exam at least opened during the time we would have taken it in class. So for the earliest test that I would have given would have been for the 10 o'clock class, and that would have been on Wednesday between 9:45 and 11:45. The latest I would have given a test would have been on Friday at 12 o'clock for the 1 o'clock class. So here's what I'm doing. I'm going to open this, and it's going to be available between Wednesday 8 a.m. and Friday 11:59 p.m. for all sections. Now, again, this exam will require the lockdown browser and monitor combination. Um, get in touch with me if you have any issues with that, but that's what we're going to require. We've learned a few things from our first initial attempt at that, and so I think we'll be able to work with that. Now, the other thing I wanted to mention um, is that we're going to do some calculations here in this handout that I have. But I'm not going to go through every single question in this handout. I'm going to post the answers, and in the solutions, what you will see. Let me get the solution document up for you here so you can kind of see that. Um, in the solution, the answers, what you will see is this reference right here where it says learning objective. The learning objective, the first two numbers are going to be the chapter that it comes out of. So this is chapter 13, chapter 14, chapter 12, and you can see that throughout the document. So again, you're going to have some questions that come from all over because part of this is cumulative. So I'm going to post this answer sheet for you as well. But here in the beginning, I'm not going to go over individual conceptual problems other than just to mention what they are. The first question here is a true false about basically the required rate of return, which is related to the net present value method in chapter 13. The second one is a question out of the statement of cash flows, chapter 14, and it just asks you what section of the statement would this go into. Well, if you're doing anything with operations, it goes into the operating section. So this is not correct. It would not go in investing. And then when we're talking about here, costs can be avoided if choosing one alternative over another is relevant. That's out of chapter 12. So yeah, that is correct. And then we have a net present value calculation or a question about the concept or internal rate of return, saying that they cannot be used as a screening tool. Well, that's not true either. And then opportunity costs represent costs that can be reduced by effective management. Again, that's not true either. So this is unusual. Most of the time, there's going to be a balance between true and false questions. But in this review, they turned out to be more false than true. So you'll see some questions here coming up with what manufacturing overhead is. These are definitional type problems and conceptual problems. And I really rather spend my time right now with you going into these computational problems. The first one we have is number 9. And it says here, Kelchner Corporation provided the following contribution format income statement. Assume that the following information is in the relevant range. The contribution margin ratio is closest to what? Well, contribution margin dollars here are $72,000. And we're going to divide those by total sales, which is 180,000. So when we actually do the math, we wind up with 0.4, which is the same thing as saying 40%. So with that one, the answer will be letter B, 40%. Now we have some more definitional, conceptual questions here, but number 11 is another calculation. And it says Con Corporation produces and sells 8,000 units of product X each year. Each unit sells for $10 and has a contribution margin of 6. If it's discontinued, 50,000 of the 60,000 in annual fixed costs charged to product X could be eliminated. The annual financial advantage or disadvantage for the company of eliminating the product should be what? Well, we come over here and calculate this. And we're going to start by saying what the contribution margin is. $6 a unit times 8,000. So 6 times 8,000 gives us 48,000. We have avoidable fixed costs of 50,000. By the way, if we're going to lose the contribution margin, we normally think of that as a negative. Put it in the wrong place. So excuse my alarm. There we go. It's a negative. So we're going to lose that contribution margin, which is actually contributes to our net income. We're going to avoid these fixed costs. We're going to gain that money back. So what we actually have in the long run is a positive financial advantage here of $2,000. Basically, this means if we give up that product, we will have a financial advantage of $2,000 for the year. So we go back to this question, and it'll be letter D, which is 2,000 and a positive. So that's an advantage. So again, there's some more conceptual type questions here. I will tell you there are more questions on this practice exam than will be on the final. However, the type of questions that are here are the kind that you can expect to see. So, just some questions like, okay, here's the one that's a good one. When preparing a direct materials budget, the required purchases of raw materials equals letter B, raw materials needed plus desired ending inventory minus beginning inventory. So that's really all that's needed there. And like I said, these are going to be definitional or conceptual in nature. You just need to know the relationships between them. By the way, one thing I want to mention here, we have a question about a joint product. This comes out of chapter 12. We didn't really do a lot with joint products there, but I do want to reinforce this. A joint product is one of several products produced from a common input. Again, keep that in mind, okay? Number 19, joint product. Okay, so we'll get down to our next computation, which is on number 22. It says Kirkleby Corporation is a shipping container refurbishment company that measures its output by the number of containers refurbished. They budgeted for 32 containers, but 34 were actually refurbished. So we got to calculate what is the refurbishing materials in the flexible budget. Refurbishing materials are $700 per container refurbished. So we'll come over here and we'll say, okay, how many containers did we actually do? We did 34 instead of 32. and it costs $700 for the materials per container. So our cost in the budget will be $23,800. When we come back here to this document, that's letter B. So that's the answer to number 22, letter B. 23 is a net present value problem, and I wanted to do one of these and have you do one of them in practice. There are separate exhibits, and that's the present value tables that I've included in this in the module for chapter 13 and 14. But I'm going to go through this and show you the calculation, and then let you know that should a net present value problem appear on the exam, you will not be able to access a separate document. So I will make sure that the table or portion of the table that you need is included with that problem. So you will not have to look it up. It'll be in the test itself. So number 23 tells us, let's go back to it, that they're going to invest in a project for $350,000, generate annual cash inflows of $133,000, and it's going to be 4 years long. At the end of the project, they'll sell the equipment for $32,000, and the company's discount rate is 14%. What is the net present value of the project? Well, let's go calculate it. So we're going to start out with an initial investment of $350,000. And anytime we're putting money out into a project, we're going to consider it a negative cash flow because we're putting the money out. And anytime we do it in the current year, the discount factor will always be 1. So our net present value of cash outflows in the current year is going to be negative $350,000. Okay, the net cash flow for year 1 is going to be $133,000. And the same thing for year 2. And the same thing for year 3. And the same thing for year 4. However, in year 4, we have an added cash flow. We're going to sell the equipment and get $32,000 back. So we're going to add these up for our total cash flow in year 4. And actually, that won't change anything here in years 1 to 3, but I just want to show the subtotal. So now we're down to the discount factor, and what we have to do is go to these tables to look them up. And because we're doing it on a year-by-year basis, we are not looking at an annuity. We're looking at the present value of $1. So we go to the percentage, and we look in the first year, we're going to have year 1. So the discount rate's 14%, so that'll be 0.877. So 0.877. We multiply that and we get 116,641. The next one, year 2, we go to 14%. Year 2 is 0.769. And that calculates a cash flow, present value cash flow of 102,277. We go to year 3, it's 0.675. So 0.675, and that's 89,775. And in year 4, we have our last present value factor of 0.592. Come over here, 0.592. We have 97,680. So and we basically, then we take the total of all of these. So we're going to add all of these numbers up and subtract out the 350,000. We have a net present value of 56,373. Go back over here, and that's letter B. Now, I don't anticipate you having one where you have to calculate 4 different present values in multiple choice. But it is possible that something like that could be one of the problems that you will see in the test itself. Okay, so for number 24, we have another calculation. It says Bonilla has a $700,000 investment opportunity with the following characteristics: sales of 2.240 million, contribution margin is 40% of sales, and fixed expenses are 739.2. The ROI, or return on investment, is closest to what? Um, so we have to calculate the net income in order to figure out return on investment. So we start out with the contribution margin by taking the 2,240,000 times the 40% contribution margin to get 896,000 as a contribution margin dollars. So we go back here. The fixed costs are 739.2. So we take that 739,200, and we have a net operating income of 156,800. Okay, we're going to take that 156,800 and divide it by the average operating assets, which in this case is the total amount we invest in the project of 700,000. So coming back here, we have 700,000, and we divide those. We get 0.224, but remember, when you're going from a decimal to a percentage, you move it over 2 places to the right. So in this case, the answer is going to be 22.4% is the return on investment. For number 5, we have a slightly different approach. This also comes out of chapter 13, but it's calculating the payback period. It says Jarvia is studying a project with a 10-year life and would require $450,000 investment in equipment with no salvage value. Project would provide net operating income each year as follows. You have a net operating income of 105,000, but remember, in the payback period, we add back non-cash expenses like depreciation. So we're going to come over here and calculate this. We start with net operating income of 105. We add back 45,000. We get 150,000. Now, the investment we're going to make in this is the $450,000. So we're going to take that 450. And unlike the homework, this has a regular, predictable annual cash inflow of 150,000. So we can use that without actually setting up a chart or a table. And so we take the 450 divided by 150,000, and the payback period is going to be 3 years. So when we look at this document again, it's letter C for 3 years. Okay, that's number 25. The next one with a calculation is 26. And this one is going back to chapter 10. This is a standard variance. Basically, it says here that this company produces a product with the following direct material standards, and it gives you the quantity, price. It says the company produced X number of units in November using 28,710 pounds of material. During the month, the company purchased 30,800 pounds of material at a cost of 117,040. And the bottom line is they want the materials price variance. For the purposes of our calculation, we are interested in the amount of material the company purchased and the price they paid for it, and the standard price per pound. So let's go over the calculation here. And number 26, right there it is. So the materials price variance is the actual quantity times the actual price. In this case, they don't give us the actual quantity, actual price. They give us the total cost for the material they purchased. We have 117,040. And we're going to subtract from that. Well, I can just do this. we'll subtract from that the 30,800 pounds. That is the actual quantity they purchased, times the $4 per pound. So we have the formula set up now is 117,040 minus 30,800 times 4. So 30,800 times 4 is 123,200, 117,400. We subtract 123 from 117 because 123 is a standard. We get, I did that wrong. It should be 117,040. It didn't look right. Okay, that's right. Now 117,040 minus the 123,200, and we get a negative variance of 6160 because it's less than the standard. This is a favorable variance. So we go back here to the document. We would say we have a 6160 favorable variance, which is letter D. Okay. Now we have another calculation in number 27 that says McGinnis Corporation's relevant range of activity is 3,000 to 7,000 units. The average costs in that range are as follows. If 6,000 units are produced, what is the total amount of direct manufacturing cost incurred? Let's go calculate it. So we're going to have direct cost, which includes the direct materials cost of $5.20 per unit. Direct, and that comes from right here. This chart, 520 a unit, 375 a unit, 3.75. We're going to add those together because that's going to be the direct manufacturing cost. The units produced are going to be 6,000 because that's what they ask us in the problem. What will it be if they produce 6,000 units? So we multiply that, we get 53,700 as total direct manufacturing cost. And we go back here to the document, we'll see that is letter B. Okay. All right. So next, we come down to letter number 28. We have this Sharp Corporation produces 8,000 parts each year, which are used in the production of one of its products. The unit product cost of the part is $36, computed as follows. There's a variable production cost of $16 a unit and fixed production cost of $20 a unit. The parts can be purchased from an outside supplier for only $28 each. The space in which the parts are now produced would be idle, and fixed production costs would be reduced by 1/4. Based on these data, the financial advantage or disadvantage of purchasing the product from the outside supplier would be what? Well, we'll calculate it. So we start with a variable production cost, which is going to be the 8,000 units times $16. That's the variable portion. Now we're talking about an avoidable fixed production cost per unit, and that's going to be the 8,000 units times the $20 per unit times 0.75 because you're going to save a quarter of the cost. So we have cost here of 120,000. So it's still going to have that cost. Well, no, this will be the cost of making it. So we'll add those together. We could avoid a quarter of the cost, but we can't avoid 3/4 of the cost. So the cost to make it is 248,000. If we buy it, they're going to charge us $28 a unit. So we take 8,000 times 28, and we get 224. So what we actually have is a reduction in cost of 24,000 if we buy the parts. So when we go back to the question, and by the way, this is not 39, this is 28. The answer is going to be letter A because we are able to reduce the cost by 24,000, and therefore that's a financial advantage. Okay. Now there's some more of these questions, which are types of questions about definitional things. And again, I'm going to include the answer sheet so you can look at those and check yourself on them. But I would practice with these. There's one question here from chapter 7, and basically it asks you which of the following being an acceptable measure of activity for a material handling activity cost pool. And if we're looking at that, letter B would be correct because you could do it either way. You could go with number of material moves or the weight of the material that's being moved. Either one would work. All right. Number 31. Well, we're not going to go into that. These are definitional, and really, this is a formula. And when you prepare for the exam, you should be able to write some of those down on your note cards. Okay, this is what I wanted to get to. Number 39. Melbourne Corporation has traditionally made a subcomponent of its major product. Annual production of 30,000 subcomponents results in the following costs. Melbourne received an offer from an outside supplier willing to provide 30,000 units at a price of $28 a unit. Melbourne knows that the facilities now being used to manufacture the subcomponent could be rented to another company for 80,000 per year if the subcomponent were purchased from an outside supplier. There would be no effect of this decision on the total fixed manufacturing overhead of the company. Assume that direct labor is a variable cost. So we need to calculate this make or buy decision. And this really is 39, but it's over here. So when we make it, we go back to this schedule to get the numbers. When we make it, we incur $250,000 in cost for materials, $200,000 in labor, and $190,000 for variable overhead. We need to include those on this calculation. So we have 250, we have 200, and we have 190,000. Nope, 190. And then we add those up and we get a total cost. Now, if we buy these, the outside supplier, we're going to buy 30,000 times 28. However, if we do that, we can rent out part of the factory to somebody, so we get to reduce that cost by 80,000 because that's the rental we would receive off of that vacant factory space. So when we add these up, we get 760,000. So if we purchase these parts, it would cost us 120,000 more in cost. And the answer to go back here for multiple choice would be letter A, I'm sorry. Letter A, 120,000, because this is a disadvantage. We don't want to do it. It will cost us more money to actually purchase those. So that's a review of multiple choice. On Monday, I'm going to do a review of problems for everybody. And we'll have some problems of the type that will be on the exam. Remember, this is a sample of the exam or a sample of what could be on the exam. These are good things to be knowledgeable about and be able to calculate and compute. Just make sure that your note card is ready and that you are prepared. So take care. I'll see you next time on Monday.